So first of all, thank you for attending today. This is the first in a series of webinars that we're running, which we've entitled Lockdown Learning for a fairly obvious reason. So I hope everybody's keeping well and hopefully even maybe making use of some of this lockdown time. And so that's really what the next 30 minutes is all about. We're going to be looking at RFM. RFM stands for recency, frequency, and monetary value. And it's all about using your data to grow your business. Whether that means right now during the lockdown, if you're fortunate to still be focused on selling PPE equipment or some products like that, like some of our customers are, or if you're indeed a little bit locked down and waiting for things to pick up, then perhaps now is a great time to be figuring out some of these things so we can all come back stronger than ever. So let's take a look. So first of all, the things I'm going to cover first of all is why you should care about RFM. What is it, how it works, and then at the end we'll look at some things that you can do next and the upcoming webinars in the series. So first of all, why do you need RFM? Why is it actually important, particularly in wholesale and distribution businesses? Well, the very short answer to that is RFM segmentation can be used to drive growth, particularly in wholesale distribution and manufacturing businesses. And it's a really powerful and I think often used technique in big wholesale and distribution businesses, and is perhaps something that SME wholesalers and distributors should be doing much more. And the reason why we should be doing it is that everybody wants a repeatable, scalable, and predictable way to grow their business. And to do that, you need to understand your customers and what they want from you at each stage. And ideally, they want you to be a mind reader. And that's kind of where RFM comes in. It allows you to figure out those customers so that you can effectively be a bit of a mind reader and hit them with the right information at the right time. But before we get into that, let's just tackle a bit of related modern marketing and sales theory in terms of the funnel and the flywheel. And there's a bit of an ongoing funnel versus flywheel debate when it comes to sales marketing theory at the moment. Somewhat of a battle between Salesforce, the purveyor of the funnel, and HubSpot, who want to prove that they're cleverer than Salesforce and have got a different idea. But in truth, they're both right to an extent. And yes, of course, you need to bring in new customers, and that's always a sales marketing focus. But it's also true that you can't afford to have a leaky bucket. You can't afford to bring them in and then lose them just as quickly. So you need to be able to service them, make them happy. And ultimately, to be really successful, you need to do both. You need to operate a funnel and a flywheel. And like all theories, they're a bit of an oversimplification. The reality is a bit more complex, but it turns out that because the reality of wholesale and distribution is pretty complex, these concepts are actually way more important in wholesale distribution. And fortunately, when you understand your data, it turns out that in a wholesale and distribution business, predicting customer behavior is actually much more important and much more useful, but also easier to get right. So let's look a little bit more at a specific funnel and flywheel for wholesale and distribution. So in wholesale distribution, it's really about making the funnel and the flywheel work together. In any business, you want to be able to maximize the flow of new customers coming in, but in wholesale distribution, it's even more important than other types of B2B businesses to maximize the retention, the respend, and the upsell. If we take a simple example we can all recognize, whether that be selling and distributing premium coffee to coffee shops, bikes to bike shops, packaging to all kinds of shops and businesses, or food to delicatessens and restaurants, or raw materials and components to manufacturers. Whatever it is you're distributing, one thing that's really common is that the first sale to a customer is rarely profitable. By the time you've put loads of effort into attracting a whole bunch of quality leads to start off your pipeline, by the time you've put some sales effort into getting that customer, and you get that first order, you probably haven't made a profit. You've probably spent significantly more in getting that first order than you earned from the £500 worth of components that you sold in the first week, or the £200 worth of coffee you sold to a hotel for their use in the first couple of weeks. So it becomes critical to understand those customers and manage them after that initial flywheel. And it becomes important to onboard them successfully to make sure that we get them into that kind of regular buying pattern. We then have to retain those customers for as long as possible, because the return on sales and marketing investment might take 6 months, 9 months, maybe even a little bit longer. And that's just to get your return on investment. In order to actually make a successful profit out of each customer, you perhaps have to retain them for much, much longer. And the longer you do keep them for, the more profitable overall the lifetime value of that customer is. Obviously, we can improve that if we can upsell those customers, and ultimately, if we can spot declining or potential churning customers, then we can do something to reactivate those, and again, build the average lifetime value of across our customers quite significantly. So that's all pretty understandable, but what's this got to do with RFM? Well, if you want to execute these 6 key strategies successfully, then you have to understand where your customers are, and you have to be able to do this profitably, at scale, and predictably, which means that you have to use the data that you've got on your customers to help them through each stage of this and help your team to be successful at every stage. And there's lots of things that we could talk about for each of those 6 stages, how to be more successful at attracting customers, how to be more successful at closing deals. And during this series of our lockdown learning, we'll get onto some of those. But the reason why we're starting with RFM is it's because it's the only type of analysis and the only tool that you can use that will literally help you with every single one of these 6 key stages. So that's why we should care about RFM, but what is it? So RFM is the segmentation of customers by recency, frequency, and monetary value. Recency is obviously a score of how recently they bought from you, and it's usually expressed and calculated as a ranking score of 1 to 3 or 1 to 5. Frequency is a score for how frequently they've bought from you, usually over a given period of time, so either over the last year or the last 2 years. And again, it's expressed as a rank or scoring from 1 to 3 or 1 to 5. And then monetary value, the M, and it's definitely RFM and not RFV if you're sort of Googling for more information on this. So the M in RFM is how much they've spent with you in total over that period. And again, it's scored with a ranking from 1 to 3 or 1 to 5. So I said in that, as I described each of those very clearly with a score of 1 to 3 or 1 to 5. But it's important to kind of understand what that score really means. So if you analyze all of your customers in a given cohort, and I'll talk about cohorts in a second, and across that cohort work out the range of recency, frequency, and value that you get in that customer base, and then effectively split that range into 3 or 5 equal buckets. They don't have to be equal sized buckets, but you can use different sized buckets, but usually it works fine just using equal distribution. Then you can put each customer into one of those buckets and give them a score. So if you take recency, for example, if we look at the customers who've ordered within the last 2 weeks, then they would get a score 5. If we take the customers who scored, who ordered within the last 3 months, they'll get a score 4, and down to 1 for customers who've ordered in the last 2 years or the last 18 months, whatever is the range of your data that you're looking at. I mentioned cohorts because if you do have some very different and diverse sets of customers, you'll effectively want to be doing this differently for those different sets. And in particular, in terms of monetary value, that tends to make a difference. So if you've got some direct customers who are independent retailers, and you've got a supermarket as a customer, then there is no point in comparing all of your independent retailers against the supermarket in terms of monetary spend, if they're really massively diverse. But I would say that if you come up with more than 2 or perhaps 3 cohorts, then you're probably doing it wrong. It is about measuring the different customers against each other. You just want to use cohorts if you've got really different types of customers. And a really good example of that would be maybe if you sell to pubs directly, but you also sell to a distributor who distributes in bulk to hotels. Just the profile of sales to that distributor may well be very different to the independent pubs who you're supplying on a weekly basis. Okay, so first of all, you create those buckets and then score each customer. And then you build a model using that scoring. So here's a fairly simple Rubik's Cube model using the 1 to 3 scoring. And you can see that your best customers, unsurprisingly, end up with a 3-3-3 score, and your worst customers end up with a 1-1-1 score. And you can see that you're basically building this out of those 3 dimensions to put your top customers in the top far corner and your worst customers in the bottom near corner. And that's what it looks like when you do it in 3D. When you do it in 5D, it becomes significantly more complicated. But 5D, a score of 1 to 5 in 3D is really the classic way to do this calculation and do it well. And it allows you to then sort of build quite important profiles of customers and give those names that we'll look at in a second, where, for instance, your very best are your champion customers, and the very worst are the ones that you've probably already lost, or if you haven't lost them already, you are in the process of losing them. So one important thing to understand about the RFM scoring is that it's definitely not just about identifying the higher scoring customers. Actually, if I went to most of your sales team or your customer service team, you could probably tell me who all the top scoring customers were, and you're probably already doing things with them. It's about customers across the whole range, from the middle scorers to the lower scorers, and those very different positions in that 3D diagram. So the lower scores help you to identify things like newer customers that need to be onboarded and nurtured so that they succeed with you. To identify previously loyal customers that have found a replacement product and need to be entered into a reactivation campaign where you kind of jump on that as early as you can and hopefully displace the competitor before they get there. They sink their teeth too deeply into your customer. And also identifying customers who buy low value items regularly and perhaps are prime candidates to move up the chain if you could get them into some kind of upsell campaign and get them to buy more premium products or just a bigger range of products so their average value starts to climb. So those are some specific examples. One of the problems with RFM is that actually it's quite hard to work with 3D models. Human beings aren't very good at thinking in 3D, and so it's quite hard to illustrate and visualize all of that data and figure out what to do with it. especially if you want to see all three sides of a three-dimensional diagram in one go. So RFM is usually visualized by flattening that 3D diagram into a two-dimensional pictogram. And it looks something like this. So in this 2D visualization, new customers arrive in the bottom right as new customers. And if they start to spend frequently and with a decent value, they start to rise up the right-hand side through potential loyalist into loyalist and eventually becoming champions. But equally, a good and frequently spending loyal customer can easily drift into sort of needs attention, then at risk, and in the very worst case, you can find a high spending customer who stops buying or stops buying as often, and perhaps they haven't ordered in a while, and they start to fall into the can't lose them or don't lose them is the term I prefer. You definitely can lose them, and you will if you don't do something about it as soon as possible. So ultimately, a customer who cannot be re-engaged or doesn't re-engage fully then becomes a hibernating customer and eventually drops, completely out of the diagram as lost or churned. So this 2D representation, I think, is much easier to understand and helps you to see what's going on and the direction of travel that you're trying to achieve and the direction of travel that you're trying to avoid. And obviously, if you look at your customers, it can be a very fluid situation, particularly, in a disrupted scenario like we're in at the moment. So ideally, all of these calculations need to be recalculated and reshared with the team, at least on a weekly basis, and if not on a daily basis. And when we talk about recalculating, we're also talking about having to reassess those buckets as well. Because if some customers become really recent, you need to change your range of recency. If some customers become much more frequent, then the frequency needs to change. You probably don't need to recalculate the buckets every day, perhaps once a week or once a month, but you do need to calculate each customer's score once a day or once a week. And of course, that's a very hard thing to do manually or even on a spreadsheet. So that's where customer relationship management software comes in. And some of you will have already seen the feature that we released recently, where we're now calculating this using the data in your system for you every single day. So every day, our software is looking at all of your customers and all of the transactions over the last 2 years, assessing the correct buckets to use, and then for each customer doing that 5D calculation, and then flattening them out into this 2D chart so that you can see which customers are your champions, which ones are your loyalists, which ones are at risk, etc. And you can access this if you've been, not all of our customers get upgraded at the same time, so we roll out new software in waves to customers over time. But if you should, almost all customers now will be on a version that allows them to run these reports. And you can access this report from marketing reports, and in there you'll find a report called Customers by RFM Segment. If you want to see a bit more practicality of this, as you'll see later on, part of this lockdown learning series, we've got some strategic and very ideas-based learning, but we've also got some more practical and tactical learning as well for how to actually execute some of these things. And we'll certainly be looking at how to run and use these reports in some of those coming up. So that's the basic report that will give you that. And also, if you look at a customer record now, you'll see the at a glance has been updated to give you that RFM segment, and also give you a little identification of when they last ordered. And if you click on that or go to the sales analysis page on a customer record, you'll see some new charts and some more analysis on the recency, frequency, and monetary value, and the trending of that customer purchases over time. So that's what RFM is and how to calculate it. Let's look a little bit more specifically about how you use it and what you do with it. So here's a couple of simple examples to get us going. If you've got some new customers, you need to identify those and who's in that group, in that segment, and then use that list to onboard those customers. And I think in a lot of businesses in B2B, that's really about personal contact and really regularly contacting that customer and focusing on getting them to the second, third, and fourth order. In the analysis that we've done across our customers and their customer bases, it really seems that the fourth order is the magic number. That if you get a customer into the second, third, and fourth ordering pattern, then you'll get them into regular buying, and they'll just keep buying from you without as much effort following on from that. And you'll see some analysis of that, as I say, in some of those upcoming events that we're running. And really, for new customers, it's all about turning them into those, getting that fourth order out of them, and then turning them into regular, loyal customers. If you take your champions, identifying who your champions are allows you to promote new products to them. They're the ones who will really listen to new products. Even when those products are in the development stage, you can even talk to them about your new products and get feedback from them about those products, or about what they want from you, or about the packaging that you're using if you're looking at revising your packaging, and really get from them what's important to them so that you can service them well, because they're your champions. They're the people that you need to be focusing on. And also, they're the people that you can ask successfully for referrals, case studies, and you can use them to work out what your ICP is. If you don't know what ICP stands for, definitely come to one of the webinars that we're running in this series, and we'll explain what that's all about. And if you can identify your hibernating customers, these are the people that have bought from you in the past, have perhaps even bought regularly and of a decent value, but are not currently ordering from you. Obviously, in the current situation, there may be other reasons for that. But under normal circumstances, when we return to normal, if you can identify your hibernating customers, they're the people you should target with offers like a 20% off if you place an order this month, just to get them back into the habit of buying from you. Perhaps they've started buying from somebody else, or they've just sort of gone off buying that thing and they're now buying something else. If you can get them buying again, then hopefully they'll start getting back into a repeat pattern. But the reason why you're segmenting these is that there's no point, for instance, in promoting referrals or case studies to your hibernating customers. They would receive that as quite an odd thing to do. And equally, there's no point in sending a 20% offer to place an order this month to your champions who were going to place an order anyway. All you've done is reduced your margin by doing that. We can look more broadly across all of these different groups with the kind of activity that you should be doing for each of those. And I'm not going to read all of this out. We'll be sending out a recording of this webinar. You can kind of have a look at those then as well. But we've also written a blog article which has got this table in it, so you can then use that to study it, and we'll send a link to that out as well. So in terms of actionable things that you should definitely do, so first of all, evaluate your ICP, get testimonials and case studies so that you can target the right kind of new opportunities and really aim at getting new future champions. So once you've got those ICPs, testimonials and case studies, you can compare that with the new biz campaigns that you're running and the leads that you've generated over the last 6 months, and see whether you're really generating the right kind of leads. Are you generating leads that match your ICP? And if you're not, you need to kind of make a change so you can focus on creating future champions. You don't want to create future hibernators or low spending customers. You want to create future champions. And obviously you then use the case studies, testimonials and personal references to close the right leads and get those new accounts signed up. The third key actionable item is to stay on top of the new and potential loyalists. So really get them onboarded and turn them into regular buyers. And if you've got lots of new customers coming in, certainly at the moment you'll be very lucky if you have. But you know, when we come out of the lockdown, there will be a lot of churn in our market. Some of our competitors will have gone bust, and there will be opportunities to generate lots of new inquiries. And if you are doing so, you need to focus on those that match your ICP and spend the most time on those because they'll be your future champions. You also need to target your existing customer campaigns and special offers to keep pushing new customers up the diagram and get your older customers moving to the right. So think about the special offers that achieve that change in behavior. So move older customers to the right with promotions and move customers up by getting them to look at more regular buying or higher value items. And carefully target your upsell on those that will respond, and don't waste bandwidth with customers who won't be receptive to those messages. Customers only have a certain amount of bandwidth, and you just cannot send everybody every message that you want to send out every 5 minutes. You'll be wasting bandwidth and making them less likely to respond to the next message you send out. So save that bandwidth by sending them appropriate messages that they'll actually respond to. And the final thing is to focus your account management activity, I'm particularly talking about the manual activity, which is quite expensive and unscalable, at the at-risk and do not lose them. Or better yet, use another feature that we released recently, the AI predictive churn reports, to really focus on the right customers and use that as a faster predictor. And you'll find that those AI alerts are actually much faster predictors than RFM. So they'll tell you about a predicted churn event or an at-risk customer long before it's reflected in the RFM analysis, which is inevitably very backward-looking rather than forward-looking. And if you haven't seen that announcement, just very briefly, that there's a new report that you can access from the sales reports called Predictive Churn Alerts, and this literally uses a whole load of statistical data and some AI analysis to then identify customers that should have ordered. So for every customer, it'll go through their previous activity and work out how long you should wait before worrying that you haven't had an order from them, and compare that with the number of days since the last order in order to create an alert of customers that you should speak to. So, you know, in this example, you can see there's a customer here, Browns, who were 16 days since their last order, and the AI engine predicts that they should order about every 13 days. And because they're a potential loyalist, you know, that's somebody that we might want to talk to. Looking a bit further down on the yellow trading company, they should order every 5 days. So they have been previously a very regular orderer, and it's now been 31 days since they've ordered. So, you know, obviously, again, in the current climate, there might be good reasons for that, but we should be looking at each of those and making sure that we're on top of that, particularly as things start to return to normal and customers get back into more of a regular buying pattern. And as James Turton, one of the people we sent this to early on to get some feedback, James said, those reports are great. The churn report has already enabled us to reactivate 2 customers that we didn't even realize we'd lost. You know, and you can't beat that kind of feedback. So certainly have a look at those as well. So, but returning to RFM, again, just to re-emphasize that RFM is really key to helping you with some of the strategies right across your business. So helping you to attract, close, and onboard new customers through the funnel, but also helping you to retain, upsell, and reactivate them. So what's next? Well, in our lockdown learning series, the first one was RFM, and we've just covered that. The next one next week will be on winning marketing strategies in wholesale and distribution. And there'll be a bit of overlap with some of the RFM analysis. We'll be touching on that again in a bit more detail for marketing, but we'll also be looking at some more strategies for success. And in particular, we'll be looking at ICPs, personas, and how they work together with RFM to make more successful marketing. And then we'll have a more tactical session, which is actually about using those strategies and turning them to tactics that you can use using your CRM data and marketing tools like Communicator and MailChimp. We'll then have another strategic one, looking at successful sales management in wholesale and distribution. And then again, a more tactical one, looking at actually how you configure your pipelines and processes and reporting to help you with that sales management activity. And then the final one, once we've kind of got all of that set up, we'll just look at how you can do better user training and make sure that your users are skilled up and engaged with the CRM and all of these processes that you've put in place, so that they, the engine room of your business can actually use all the stuff that you set up and all the strategies and tactics you've put in place successfully. So that next one is the winning marketing strategies. And next week, that'll be on at 3 o'clock on Thursday, the 23rd of April. And look out for an invite to that one, which will be coming out to you shortly. Okay, thank you very much for attending. I hope you found that useful, and I look forward to seeing you on the next webinar. Thank you very much.